The average property in the UK now costs 9 times the typical salary. The last time house prices were this expensive relative to average earnings was the year 1876. This is no longer a housing crisis, but a ticking time bomb that now threatens the UK economy. According to the Office for National Statistics, the median household disposable income in the UK is just under £37,000 per year, while the median house price sits at around £270,000. That gap alone tells you everything you need to know about how distorted the housing market has become. Housing stress is defined as spending more than 30% of disposable income on housing costs. At today's prices and interest rates, a median income household trying to buy a median-priced home would be automatically rejected for a mortgage. This is why banks have become non-existent middlemen at this end of the market. You need a bank loan to enter the housing market, but the banks will not let you enter the market in the first place if you earn the median income. And this is a structural problem, not an individual one. Millions of households are doing everything right, working full-time, saving diligently, and yet they are locked out entirely. The system no longer works for the people it was supposedly designed to serve. But what if a median income earner could get a loan at no interest? In this video, I'll explain how houses can be made affordable again using 2 key policies, and why they matter now more than ever as the UK housing bubble moves closer to a potential crash. To understand how we got here, the UK's long-term housing data is incredibly revealing. It shows very clearly that housing unaffordability is not a natural outcome of population growth or land shortages. Instead, it is the direct result of financial deregulation, particularly in mortgage lending. Before World War II, there was no long-term upward trend in UK house prices. If we set the inflation-adjusted house price index to 100 in 1980, the year Margaret Thatcher came to power, the index stood at 47 in 1845 and 47 again in 1960. For more than a century, house prices simply tracked consumer prices. Between 1845 and 1979, real house prices rose by just 0.25% per year on average. All of the meaningful increase happened between 1960 and 1979, when prices rose by about 1.75% per year. After 1979, everything changed. Once Margaret Thatcher was in power, real house prices began rising at roughly 3% per year. To put that into perspective, at the pre-1960 rate, it would have taken 280 years for house prices to double. Between 1945 and Thatcher, they doubled roughly 40 years. After Thatcher, they doubled every 23 years. This wasn't because houses suddenly became better, scarcer, or more valuable in real terms. It happened because of a fundamental change in how housing was financed.
Before World War II, household debt was stable relative to GDP. In 1947, it was about 8.5% of GDP, and even by 1980, it was still only 9%. Most housing finance was provided by building societies, not banks. This distinction matters enormously. Building societies do not create money when they lend out existing savings. When they issue a mortgage, their deposit account falls by the same amount that the borrower's account rises. No new money enters the economy. Banks work completely differently. When banks issue mortgages, they simultaneously create a loan and a deposit. Their assets and liabilities both expand. This process creates new money, and most of that newly created money flows directly into the housing market. When Thatcher deregulated mortgage lending, banks replaced building societies as the primary source of housing finance. The result was explosive. Household debt rose from about 20% of GDP to nearly 80% by 2007, right before the global financial crisis. Between Thatcher's reforms and today, house prices have risen 3.5 times faster than consumer prices. This created a vicious feedback loop. More mortgage credit pushed up house prices, rising house prices increased collateral values, higher collateral allowed banks to issue even more debt. That additional debt then pushed prices even higher.
Housing stopped being primarily a place to live and became a financial asset. Speculators entered the market, bidding up prices further. The system kept inflating until it eventually destabilized the entire economy in 2008. That is the core of today's problem. So what's the solution? There are 3 policy options, but at least 2 of them must be implemented together to work politically and economically. The first is Property Income Limited Leverage, or PIL. The second is the Affordable Housing Authority, or AHA. They must be introduced together because they operate on opposite sides of the market. PIL reduces speculative demand and leverage, pushing prices down. AHA supports genuine buyers, pushing demand back up in a controlled way. PIL would cap mortgage lending based on the rental income a property can realistically generate, either actual rent or imputed rent calculated by statisticians. In London, house prices are roughly 25 times annual rents, meaning mortgages are currently around 20 times rental income. Under PIL, that ratio would gradually fall to around 10 to 1. This would dramatically reduce leverage, eliminate speculative excess, and make housing unattractive as a financial casino, which it should never have been. But lower house prices alone aren't enough. That's where the Affordable Housing Authority comes in. Right now, the problem for low and middle-income households isn't just price, it's interest. If a median-income household somehow scraped together a 10% deposit on a £270,000 home and borrowed the rest at 7% interest, their annual mortgage payments would be around £20,600. That's more than half of their disposable income. They would never be approved. At 0% interest, annual payments fall to about £9,300, or 26% of disposable income, below the housing stress threshold. So why do banks charge interest? Textbooks claim banks lend out depositors' savings. That's false. Banks create money when they lend and charge interest because that's how they make a profit. If there were a public lender that did not need to make a profit, interest would be unnecessary. The Affordable Housing Authority would be funded by government money creation, just like other forms of public spending. It would lend 0 interest to households earning the median income or below. Buyers repay only the principal over time. This idea isn't radical. A century ago, Henry Ford and Thomas Edison argued that public infrastructure should be financed without interest. Edison famously said it was absurd that people who never turned a shovel of dirt should collect more money than those who did the work. The same logic applies to housing. Banks don't build houses, they don't improve them, they don't even lend to median earners anymore. So why should they extract hundreds of thousands of pounds in interest? Under this system, sellers benefit, buyers benefit, and even banks benefit indirectly through bond markets. The real losers are speculative profits built on excessive debt. Together, PIL and AHA rebalance the market. They lower prices structurally while restoring access to home ownership for working and middle-class families. The only policy that goes further is a modern debt jubilee, aimed at reducing excessive private debt without triggering economic collapse. That remains the final unresolved issue and the biggest threat heading into 2026. Because if private debt keeps rising while incomes stagnate, the housing market doesn't just stagnate, it eventually breaks. And history shows us exactly what happens when it does.